So this paper is a joint work with Eddie Zhang, who is sitting over there. When you see the title index trading or index investment, a lot of things come to your mind, and we just want to acknowledge them. There are so many things that you care about, things like portfolio delegation, benchmarking, information acquisition. This paper is about the CAPM. That is to say, at the end, diversification or the CAPM is the rationale for index investment. So this is what we are doing. It's not that we dismiss all those important things that are on the board, but you will not see them in this paper. We are CAPM. All right, so let me show you the model so you see what is going on, okay? So it's a static model. Only a single good, because we don't want to care about or mind about your choice between butter and milk. So only one consumption good, we focus on risk. It's a real economy, so no money. We have n risky assets that pay random payoff. Okay, it's a vector notation. If it's boldface, it's either vector or matrix. We normalize the number of shares outstanding to 1. It's okay. A portfolio is just a vector of holding, how many shares you have of each firm. So the vector of all ones is the market portfolio. We have a risk-free asset in zero net supply. That is to say, the price of the bond is endogenous. It has to be because we need to have a risk-free asset in zero net supply so that the risk-free asset is there. If it will be in positive net supply, or if we were not to have it endogenous, it will end up to be in positive net supply, then it should go up to the tangency portfolio. So the risk-free asset is endogenous. All right. Now, the first deviation from the standard CAPM, we have 2 of them. Every investor is informed. You see the information structure, and it reminds you kind of like wisdom of the crowd things, right? Everybody is getting a signal centered around the true value, the payoff vector, plus a noise. And the noises are independent of each other. Fine. Then it's an exchange economy. So every investor has an endowment. Consumption good, bonds, and portfolio of risky assets, which is a claim on future payoff. All right. Given price vector, so you give us the prices, the price of the bond and the price vector of risky assets. Every investor has a budget set or a budget equation. All right. Every investor has mean variance preference, that is to say exponential utility here, with its own coefficient of risk aversion. So we have heterogeneity in risk aversion. Now, it's the second and last deviation from the standard CAPM. We are dividing the set of investors into indexers and non-indexers. After all, we want to do comparative statics. We want to see what's happened as we change the size of the set of indexers. Okay, so we have M investors, and we divide them between indexers and non-indexers. So an indexer can only choose a scalar multiplication of the market portfolio. The market portfolio is the vector of all ones because we assume that only one share is outstanding. So if you're an index investor, you are confining yourself to the capital market line. You can buy as many bonds as you want, as much of the market portfolio that you want, but you cannot choose individual securities. The non-indexers, well, they do what they want. They choose the portfolios. All right. The equilibrium is standard. Basically, every investor has a signal. Therefore, the demand of every investor depends on information. So prices should convey information. So investors should understand it and try to extract information from prices. So when they solve their optimization problem, they condition on information not only in signals, also in prices. 3 markets have to be clear, and we got ourselves an equilibrium. is it optimal to index in our model? That is to say, we exogenously and arbitrarily say we have here a set of investors that have to confine themselves to the capital market line. Well, in a large economy, in our model, yes. So what is a large economy? It's the usual exercise where you make each investor or each agent in the model small. So let me show you what I mean by large economy in our model. So we have M investors. And our goal is to let M go to infinity. So as we build our sequence of economies, the asset payoff is also going to increase. So we increase the size of the economy proportionally to M. So we increase the number of investors, increasing the size of the firms, and our goal is to see what's happened when M is infinity. This will be our large economy. So what about the signals? So you see that V bar is actually what is important because it's informationally equivalent to V. It doesn't matter which of the two you use. So for this slide, it's easier to present it as if the signal is centered around V bar. It's informationally equivalent. What I want you to notice that as we increase M, as we go to the large economy, the signals becomes pure noise, right? So I started with a model about informed traders, but actually what we have in mind is where people don't really know anything. So what do we have in mind? What do we have in mind? But before, let me just say this. So at this point, it's already intuitive. At the limit of the sequence of economies, each informed trader knows essentially nothing. So you will not be surprised that you sort of get a standard CAPM where they don't lose anything if they remain on the capital market line. They don't know more than the market knows. Okay? And we prove it in the paper rigorously. So what kind of information we have in mind? Well, this is a model about layman investors who observe for free in their surrounding information that standalone is extremely noisy. This comes to show an example where you basically observe the parking lot in the shop. What can you do with knowing what the parking lot is? Well, let's say you notice that it's Tuesday afternoon and it's full. You say, good for love. Of course, it's kind of pure noise. But if you were to know now every parking lot in the nation, this will be valuable information. Standalone, almost noise. We can play out more examples like this. Experience with customer service. You flew in and you had a wonderful experience with the customer service of the airline, and you say, good for them. But can you really extrapolate it that much? Well, if you were to know every passenger, how well or how much they enjoy the travel or the experience, then it's a valuable information. It's not going to tell you everything, but it's nevertheless valuable. This is what we have in mind. For those of you who remember the Zeno Paradox, we basically take the information and spread it among infinitely many people, so each of them has essentially nothing, but together we do have something. Right? Kind of like a Zeno's Paradox. All right. So this is the idea of the Zeno's Paradox or the Zeno story. Our model, when you carry it to the limit, everything goes through. So it is not the case that because at the limit you have pure noise as a signal, the model collapses. So everything I'm going to show you in the finite economies will carry through to the large economies. Okay? So let me sum up. So far, we presented the model, or we present a model that deviates from the standard CAPM in two important ways. We divide the set of investors into indexers and non-indexers. And every investor is informed. I also revealed the spoiler. And the spoiler is that in a large economy, every partition is rational because it is optimal to index. So everybody will be happy or will not protest in the large economy if we will assign him to the set of indexers. So we are okay to do our comparative statics in the large economy. And the second spoiler that I revealed was that whatever we do in the finite economies will carry to the large economy. All right. So how do you find the equilibrium in such a model? Well, you read what Grossman did and you follow. So Grossman came up with a fantastic apparatus or machinery to find equilibrium, rational expectation equilibrium. So let me remind you how it goes. You give us a vector y, random vector y. You give it to us. And we take it to our agent in the model. We give them y. We take away from them their signals. So now they don't have signals anymore. They are not informed. They only know y. We also allow them to do what they want. So we forget about the indexers and non-indexers. They do what they want. This is an artificial economy. It's very easy to compute equilibria or equilibrium in artificial economies. You do it point-wise. That is to say, you pick a realization of y. Everybody knows how to compute the objective because there is no prices there. So it's easy. You don't need a fixed point argument there. So everybody knows how they maximize given what they can afford in their budget constraint. And then you find the price that clears the market. In other words, in artificial economies, prices are not conveying information. This is why it's easy. They're just budget constraint. So you solve the equilibrium point-wise. For every realization of y, you compute the price. All right, so this is artificial economy. Now look here. If you were to choose this y that is written there as equation 2 and compute the prices in the artificial economy when you give us this y, the prices you get are the equilibrium prices in the actual economy. So to understand our paper, you need to understand this y. So if I leave this presentation making you feel comfortable with this y, I did my job. Everything else is just to deliver what will become obvious. All right, so let me just say one more thing before I explain why. Y is n plus 1 dimension. It's a vector with n plus 1 coordinates. The prices are n plus 1 dimension. We have n risky asset, the vector P, and the bond. So prices are informationally equivalent to this y. Let's look now at this y, because whatever this y transmit, also prices transmit. All right, so let's look at the first n coordinates. They are the first term there, the sample mean, or the average of the signal there. It is the sample mean of the signals of the non-indexers, those investors that buy and sell individual securities. If you remember your statistics, then the sample mean is a sufficient statistics for the mean. And here the mean is the future payoff. In other words, if you were to go and interview each of those non-indexers and ask them, what do you know? What do you think? What about this parking lot? What about that parking lot? You will find out that these first terms there give you all the information that you need. There is no need to go and interview them. Once you have this first n coordinates, you already know everything that is relevant that those non-indexers know. What about the last coordinate? It's only a single one because it's a transposed vector times a vector. So it's just a single coordinate. So look at the vector G. It has nothing to do with the division of investors into indexers and non-indexers. And also the summation of the signals has nothing to do with the division. What is this one? Easy to guess. It's a sufficient statistics for the future payoff of the market portfolio. In other words, let me illustrate. I'm an index investor, okay? I observe all kinds of things. I am bullish on some companies. I am bearish on some other companies. Overall, I'm neutral. When I invest in the market portfolio, I'm sort of neutral about it. Markets cannot tease out from my trading or from my investment whether this is a situation or this is a situation. but I do give market, or I do transmit what I think about the market portfolio. This is what we see here. Index investors do transmit to market what they think about the economy as a whole. This information does not get lost when they index. What does get lost is their information or their sentiment about individual securities. Here, we beautifully see that only the non-indexers give it away. It's very intuitive. All right, now once you know this, you will not be surprised with any of the results that we deliver in this paper. I believe that they will all feel like okay, this was just homework assignment. Here they are. The uncertainty about payoff of future securities, well, when you increase index investment, it increases because we lose information. Correlation between prices increases because when index investors don't tell us if the situation is like this, or like this, or like this, and maybe like that, only that they are neutral, well, we bundle securities together. So the prices move now together. We don't separate them. So correlation in prices increases. Market portfolio is not affected, but you know why, right? We don't lose information about the market portfolio. R square of the CAPM is going down. Remember, the CAPM is not just a theoretical model, it's also kind of a statistical regression, so it's meaningful to talk about its R square. Remember, what is the R square? It's the proportion of market risk. Well, we are increasing idiosyncratic risk, R square is going down. Let me show you some figures. So we ran a simulation in our model, and we estimated the CAPM. The green line is the actual, the theoretical one that we know because we simulated. The red one is the estimated. You don't see it there. It's perfectly there. This is a simulation where only single guy is indexing. So almost everybody is a non-indexer. What's happened when almost everybody index? When almost everybody index, CAPM still holds because CAPM holds in our model. But look how pathetic R square is. Now you do see the red line, right? You do see it. CAPM holds, and we don't reject the CAPM. I know many of you guys here are empiricists, and you don't get the luxury of getting 100,000 observations. What if you were to get only 100 of them? Well, if almost no one index, no harm. You get the CAPM, you nail it. What if almost everybody index? CAPM holds, but you would reject it. CAPM holds, but you would reject it. Here how the mean variance frontiers look like. So it's kind of cute picture to show. I don't know what more to say about it, but I remind you that this is a conditional model. So we have signal being realized, then prices being computed, then return being computed, then we can draw the frontiers. So the frontiers themselves are conditional, but this is a typical picture that we see. The more indexers, the more nested it is. Capital market line is unaffected. They all have the same tangency portfolio. We can even compute the equilibrium, or we can claim that we have an equilibrium when everybody is indexing. Okay, when everybody is indexing, theoretically we should have many equilibria out there. Because if everybody is indexing, we are pricing correctly the market portfolio, nobody is trading individual securities, so many possible prices for individual securities, provided they support the price that we agreed on for the market portfolio, are equilibria or equilibrium. But we can pick one of those many equilibria, the one that is a natural limit of our model. And this is what we show in this graph. It's actually, you see a jump, but if we were to do it more refined, you will see that it's really converging. All right, I have more time. Yeah, it's okay, so I do have 2 minutes, I will conclude. So So this is what the paper is. We develop a conditional CAPM with index investors. I want to emphasize that for investors in the model, it doesn't really matter. But for the rest of us, it becomes interesting. I mean, for the rest of us, those of us who care about idiosyncratic risk, for example, those of us who care about the CAPM as a tool to make prediction or to go and argue what is abnormal event or what is not abnormal event, we care. Okay, so that's it. Thank you.